Jobs Friday. If you don't know, polled forecasters expect an increase of around 150,000 non-farm jobs in September. The employment rate is expected to hold steady at 4.2%. Joining us now, Michelle Girard, head of U.S. coverage at NatWest, as well as the CEO of NatWest Markets. And with those estimates fresh in our mind, Michelle, I should point out you're at 100, which is below, and you're at an uptick of 0.1% in the unemployment rate. So you think it's going to be a little weaker than what's indicated by the consensus?
Yeah, slightly weaker. Although, you know, unfortunately, the trend has been up. Well, not last month, but we tend to get, even when we get upward surprises, they're followed by downward revisions. So, you know, I think that that's something we're all kind of mindful of. Even if we get a stronger number than what we're looking for, we probably will see it accompanied with downward revisions to prior months. And that's a trend that's not encouraging. You know, our number, even without any revisions to the prior month, would put the 3-month moving average just around 110,000. And that's a really sharp downtick from running over 200,000 per month in terms of payroll gains over the first half of this year. So whether it's 100 or 150,000, I think the message is going to be that there is slowing pretty clearly in the pace of hiring. So
the Fed can argue that, yeah, we did 50, but it was really like 25 from the meeting where we didn't do it, and then another 25, and you know, Michelle Girard says we're at 110, so they probably feel pretty good about the steps they've taken. They can certainly justify them.
I think you're right. I think the Fed feels, you know, the fact that it has taken an aggressive step, given how high interest rates are versus neutral. There's just a lot of ground to make up. We heard, obviously, Goolsbee talking about the fact that interest rates need to come down a lot. I think he's just recognizing that the Fed is still in a pretty restrictive posture, given the fact that we have seen tangible slowing on the economy. And inflation is moving within range of the Fed's target. You know, they have that 2% target. I think we all believe somewhere between 2 and 2.5% is where the Fed feels comfortable. We expect that you're going to, you know, you're moving in that direction. We expect you'll be there by the end of the year. But meanwhile, that unemployment rate, we think, continues to edge higher. We have it ticking up today, but stepping back by the end of the year, we think that's going to be at 4.5%. And again, given all of that, inflation kind of where it is, the unemployment rate having moved up, you would think that the rate should be the Fed would feel more comfortable with rates a lot closer to at least the neutral posture.
I guess so. You think the Fed was holding it's not really a thing that could do that. The members of the Fed collectively were holding their breath with the port strike, and is there continued angst about an oil shock?
Well, you know, there's a lot of issues that I think the Fed is looking at. The port strike is just obviously something the Fed would the economy, inflation, not positive for trends. Although, let's face it, that's probably something transitory, as would, you know, potentially. Well, I know that word that hurts them. I know. I tell you, Joe, one of the things that we're starting to pick up is the uncertainty around the election. And we saw that in the Beige Book. We saw that in commentary yesterday, comments made by respondents to the ISM non-manufacturing survey. We're hearing companies starting to say that they're holding off on making decisions, including hiring, because of the uncertainty around the outcome of the November election. So there's a number of headwinds, I think, that the economy is facing around uncertainty that, you know, I think the Fed is kind of mindful of in terms of, you know, again, wanting to position the Fed to be able to support an economy that is cooling for a bunch of reasons.
Is 110 okay for a soft landing? That plays right into what they're trying to accomplish, I guess.
Yeah, it is. But, you know, 110 is probably not, you know, unfortunately, you're probably 110 heading slightly sub 100 if the trend extends. And, you know, we've talked about many times the margin for error in terms of these numbers. If you're seeing job gains sub 100, you're certainly within the realm of seeing in any given month an outright decline in payrolls. And so just to get a sense of the fact that, you know, that trend is not one. If we settled around 100 of, you know, and held there, But I think everything we're looking at, I mean, one of the things is looking at the breadth of the job gains, really, really narrow in the month of August. There's a lot of exclamation points, if you will, reinforcing the trend that we're seeing in payroll gains that suggests that the labor market is certainly softening.
We're at 385. That's been ticking up on the 10-year. Are we going? Is 4 where it's going to be even with Fed rate cuts on the horizon? Is that okay?
Well, it's interesting because you do see the Treasury yields moving down as you would expect when the Fed cuts interest rates. But one of the factors that we have to keep in mind is, again, the deficit remains very large. We're still seeing a great deal of fiscal stimulus and therefore a lot of Treasury supply. So if the idea that 10-year yields or market rates can get as low as we've seen historically when the Fed starts cutting interest rates, I think is somewhat challenged. That's why you hear people really expecting the curve to be steepening, where you will see shorter term interest rates fall alongside Fed rate cuts, but the long end might be a bit more sticky.
That's what we're seeing. Yep, that's what we're seeing.